expense the next year. So fixed interest is what's critical if you're going. The other expense we see a lot of people have questions about is, can I travel to go and see my investment property? Well, and claim it as a tax deduction? Well, the answer is, of course you can. But what you can only claim are those costs directly associated with you going to see that investment property. So, you know, if your property is interstate and you go up to see your property, you know, in normal circumstances, that's an allowable deduction. But if you decide to go and spend an extra 4 days holidaying and 1 day property inspecting, then you have to apportion those costs between the property and any personal time that you spend there. And obviously that applies if your property is overseas in the US or someplace like that as well. Now, costs associated with traveling to look for a new property you're going to buy are not tax deductible. But if you finally buy a particular property, those costs associated with finding that property, while not tax deductible, you can add to the cost base of the property, which would reduce your tax sometime in the future if you ever sold. So with travel expenses, just be careful of the proportion of amount of money spent personal versus amount of time spent physically looking at that property. And that's something, especially if you've got a large expense there, that we find the ATO jumps on and has a look at. And they normally win the argument. So if you're going to have dual purposes, just write it down, apportion the time, and be reasonably thorough with your paperwork. The other big one is land tax. Now, while we all don't like paying land tax, what's even worse is if you pay more than you should. And land tax is due and payable at a certain date depending on the state you're in. So in Queensland, the anniversary date is midnight 30th of June. For New South Wales, it's midnight on the 31st of December. So if I just use, and the other states have got similar dates, so look up the websites for the state that your property's in. But imagine in New South Wales, if you bought a property in November, you exchange contracts. If you settle in, call it the 26th or 27th of December, because you're trying to make sure you do it all before the new year, then you worth of land tax, because you owned that property as at midnight on the 31st of December. But had settlement occurred on the 2nd of January, then it's only a few days different, but you won't have to pay that land tax until that whole next year is over. So a few days different in that settlement date could save you 1 whole year's worth of land tax. And that can be quite significant. And what we find, unfortunately, happens is sometimes people in the euphoria of everything want to settle as quickly as possible so that they can take possession of their investment property, and then all of a sudden they're caught with a whole year's land tax that they had never taken into account. So be very, very careful of that land tax. And obviously if you're within the land tax thresholds for a particular state, then you don't have to pay it. So my discussion was for those people who are in a land tax paying position. The other thing that crops up at this time of year that helps expenses and income is what we call the 1515 tax variation form. So a lot of people who have negative gearing wait until the end of their year to do their tax return and then get a refund. But the problem is the ATO has had the use of your money, you know, month on month on month. And you've had to fork out personal funds or borrowed money to fund negative gearing from month to month. Through this tax variation request, you can actually ask the ATO to approve that a lower tax is applied to your income to take into account your negative gearing.